Hello, dear students. Let us understand about the concept of risk in security analysis and portfolio management. So, basic things that we are going to discuss is understanding the financial risks and the factors influencing security risk, strategies for risk mitigation. Of course, when it comes to security analysis, when we are investing our funds, there will be certain financial risks. And second thing is, what are all the factors which influence this security risk? And third one is there any strategies for this risk mitigation? So we'll discuss all these things one by one. So first one, types of risk. There are two major steps like for these types. One is market, another one is credit risk. So market risk, it refers to the potential for losses because of the changes in market prices or even interest rates. Okay. So sometimes the prices of the securities, it will be high. That is a rising market. And when it declines, we call that as falling market. Okay. We say that as bull and we are right. So where all these things, it significantly affects the investment values. Okay. If any investor, if he invested in, some security, some assets, obviously depends upon the market scenario, his investment values might change. Okay. And next is what credit risk. So it is the possibility of loss from a borrower if he fails to repay a loan. Okay. So some, asset, some investment, okay, that he procured from a borrower, if that is not paid on an appropriate period. Okay, so that liability is what missing out. Obviously, we say that as credit risk. Okay, there might be some contractual obligations like there are futures, there are options. Okay, so all these things comes under derivatives. So literally everything, it affects the financial stability. So that is the credit risk. So next is risk assessment techniques. So there are two things like value at risk. Another one is stress testing. So value at risk, it is a statistical method where we use this to, assess the potential loss. So how much loss in value? Okay. There might be some values, right? So some prices in the stocks. So how much is what declined? How much loss is what faced by the investor? We can able to calculate that using this VAR technique method. Okay. And next is what stress testing. So stress testing is another technique where we can simulate extreme market conditions to evaluate how financial institutions are performing. Okay, extreme market, like sometimes fluctuations happen periodically based on the different economic scenarios. For based on all these things, okay, so it simulates the market conditions, and it we can calculate or identify the losses or risk management system. Okay, and next is factors influencing security risk. So factors, what are the different factors? Obviously interest, another is inflation rates. Okay, so interest rates is what a very important role, it plays a very important role in financial markets. Okay, all kind of investment behaviors, okay, borrowing cost, all these things includes under this interest rates. And next is inflation rates. We cannot predict this inflation rates. Okay, sudden increase in the prices of the products. Okay, if inflation rates is what rising, obviously purchasing power will be decreased. Okay, so that is the basic thing, logical thing we need to understand under this inflation rates. And next is, so regulatory environment, like there are two risks, like two things. One is compliance risk. It is related to the laws and regulations, which is completely under the political environment. Okay, if it is what failed, yes, penalties or security breaches, all these things we have to do. If it is not maintained properly, compliance risk, we need to face that. And next one is changes in regulations. Okay, so for every period, definitely there might be certain changes. Okay, protocols will change, process, resources, everything will be changed, obviously, based on that investment process, everything, all these things will change accordingly. And next is strategies. So best strategy is, there is a term called as diversification. Okay. So under this, asset allocation, and next one is sectoral diversification. So asset allocation, like how we are gathering our different assets, okay, to balance both risk as well as return. Sector diversification, by investing in different sectors of the company, not depending on only one sector. Okay, so just diversify in different sectors. Probably you can manage somehow, even if you fail in one sector, you can gain the other sector because of this idea. Okay, so these are all the different things comes under this session. Thank you all.